$1,200. That was the check the U.S. government handed each citizen in April 2020. 1 month's rent, on average. At the same time, the Federal Reserve was writing a different check. $4.5 trillion. Roughly 20% of U.S. GDP pumped directly into financial markets. This is not a story about blame. We track the root, not the scale. In a pandemic, the central bank's options were limited. We follow one thing only. Where, exactly, did the money flow? And from that flow, who lost and who gained? March 2020. A crack opened in the global economy's reservoir. But the crack started earlier. On the surface, a bull market. Inside, a structure that could no longer survive without constant liquidity. Step back. September 17, 2019. Something strange happened in New York's overnight lending market, the repo market. The overnight borrowing rate spiked past 10% annually. The day before, it was around 2%. In a single night, it quintupled. The repo market is where banks borrow cash overnight, pledging government bonds as collateral. When money stops moving there, the entire financial system holds its breath. Like a heart that stops, the body still stands for a moment. Invisible from outside, dangerous inside. The New York Fed intervened immediately. $75 billion injected in a single night. Another $75 billion the next day, and the day after. The crack was patched, but the gap didn't close. In Q4 2019, the Fed injected over $400 billion in short-term liquidity to stabilize the repo market. They didn't call it quantitative easing, they called it repo operations. The effect was the same. Liquidity flowed in, markets stabilized. Asset prices kept climbing. The S&P 500 rose 29% that year. By then, the system could no longer function without the drip. January 2020. News broke of a new virus spreading in Wuhan, China. Markets didn't move. February 19, 2020. The S&P 500 hit an all-time high, 3,386. Nobody questioned that number. 7 straight years of gains. People had stopped asking why. Monday, March 9th. S&P 500, down 7.6% in a single day. Circuit breaker triggered. Trading halted for 15 minutes. March 11th, 2020. The WHO declared a pandemic. The official declaration came late. The dam had already broken. Thursday, March 12th. Down another 9.5%. Second circuit breaker. Monday, March 16th. Down 12%. Third circuit breaker. Wednesday, March 18th. Fourth circuit breaker. 4 circuit breakers in 10 days. A different speed from 2008. March 23rd. S&P 500, 2,237. Nearly 34% erased from the peak. In less than a month, 1/3 of market value. Gone. When the dam broke, the lowest ground flooded first. Last week of March 2020. Florida. The unemployment benefits website crashed. Not from traffic. The system was never built to handle this scale. People hit refresh all night. The screen showed one thing: error. Same time. California, New York, Texas. State unemployment hotlines overwhelmed, unanswered. The system had never imagined this. People hung up, called again, hung up again. First week of April. The U.S. Department of Labor reported 6.6 million unemployment claims for the week. The week before, 3.3 million. 2 consecutive weeks. Numbers not seen since the Great Depression. In a single week, a number of people equal to New Zealand's entire population lost their jobs. Most were service workers, restaurant workers, hotel staff, retail clerks, flight attendants, people who cannot work from a screen, people who work with their hands, people whose income is labor, not assets. Those who earn with their bodies flooded first. April 2020. Unemployment, 14.7%, the highest in U.S. history since the Great Depression. Black unemployment, 16.7%. Hispanic unemployment, 18.9%. Asian and Latino small business owners closed at the fastest rate. The low ground flooded first. The lowest ground went deepest and stayed submerged the longest. Then the central bank's giant pump switched on, but the water it pumped flowed only uphill. Sunday night, March 15, 2020. Fed Chair Jerome Powell issued an emergency statement 2 days ahead of the scheduled meeting. Time of announcement, 5 p.m. Markets were closed. The message was clear. Interest rates cut to near zero. Treasuries and mortgage-backed securities, large-scale purchases, and if needed, more. March 23rd. The Fed went further. Unlimited asset purchases, declared, no cap on scale. First time in history, the U.S. Central Bank used those words. And that day, by coincidence or otherwise, was the bottom for the S&P 500. Look at the Fed's balance sheet. February 2020. Total assets, $4.2 trillion. June 2020. $7.2 trillion. End of 2021, $8.9 trillion. In 18 months, $4.7 trillion was added. That is the size of Japan's entire GDP. Where that money went, that is the question at the center of this story. Here is the first key transaction. Date, March 23, 2020. Decision maker, the U.S. Federal Reserve. Program, SMCCF, Direct Intervention in the Corporate Bond Market. Delegated operator, BlackRock. The program calmed panic in the corporate bond market. Once prices recovered, corporations could raise capital again. BlackRock is the world's largest asset manager. Before the crisis, $7.4 trillion in assets under management, larger than the GDP of Japan, the world's third largest economy. The Fed hired this company to buy corporate bond ETFs with public funds. There was a problem. Some of the ETFs BlackRock was instructed to buy were BlackRock's own products. In other words, BlackRock was using Fed money to buy funds it managed itself. When you buy your own fund, its price goes up. The gains go to BlackRock's clients, and throughout the process, BlackRock collects fees. Conflict of interest concerns were raised. BlackRock stated it followed regulations and waived fees on its own fund purchases. The Fed said it chose the most capable institution. Legally, no violation. But the structure was already built that way. The crisis simply raised the elevation of those already on high ground. Look at BlackRock's assets under management. End of 2019, $7.4 trillion. End of 2020, $8.7 trillion. End of 2021, $10 trillion. $2.6 trillion added in 2 years. This was not simple market growth. It was a structural opportunity created by the crisis. Second receipt. Date, March 27, 2020. Legislation, the CARES Act. Signed by President Donald Trump. Size, $2.2 trillion. The largest economic stimulus package in U.S. history. Here is how the money was distributed. One-time check per adult, $1,200. Per additional child, $500. Paycheck Protection Program for small businesses, $669 billion. Bailout for large corporations, airlines, cruise lines, hotels, $500 billion. Hospital support, $100 billion. State and local government support, $150 billion. Each citizen received one check, $1,200. Corporations received hundreds of times that. Congressional hearings and audits later revealed something simple. Some PPP loan recipients, instead of maintaining jobs, bought back their own stock, paid executive bonuses, and much of that loan they never had to repay. The problem here is not corporate greed. The crisis design created stronger incentives for balance sheet protection than for job preservation. Third receipt, period, March through December 2020. Sellers, small business owners across the United States. Buyers, Amazon, Walmart, big tech platforms. After the pandemic was declared, more than 200,000 small businesses in the U.S. alone permanently closed. Bookstores, independent restaurants, small clothing shops, local gyms. Where did their market share go? Amazon's 2020 revenue, $386 billion, up 38% from the previous year. Jeff Bezos' net worth grew by $75 billion that year, more than $200 million added per day. Apple stock, up 82% in 2020. Tesla, up 743%. The pandemic compressed a decade of digital transformation into months. When people could no longer leave their homes, consumption shifted, offline to online, fast. Every time a local bookstore closed, that demand flowed to Amazon. Every time a local restaurant shut down, that demand flowed to delivery platforms. The rate at which small offline businesses lost market share to online platforms accelerated to 10 times the normal pace. Fourth receipt, period, March 2020 to the 2022 peak. Sellers, dollar holders, cash savers, the assetless. Buyers, stockholders, property owners, crypto holders. Printed money hit asset prices before consumer prices. 2020 consumer price inflation, 1.4%. 2020 S&P 500 annual return, 16.3%. 2020 NASDAQ return, 43.6%. 2020 U.S. home prices, Case-Shiller, up 10.4%. 2020 Bitcoin return, 305%. Those holding cash felt safe. Prices barely moved. But the moment they tried to buy something after asset prices had already surged, they understood. The same money bought less. Purchasing power had been quietly, rapidly consumed. When water rises, high ground gets higher. Those on low ground went deeper. One critical fact: the top 10% of U.S. households own approximately 89% of all stocks. The bottom 50% own less than 1%. So when the stock market rises 43%, nearly all of those gains go to the top 10%. The Federal Reserve's distributional financial accounts tell the story. From 2020 to end of 2021, the net worth of the top 10% in the U.S. grew by more than $3.5 trillion. The bottom 50%? Virtually no change. When the Fed prints money and injects it into financial markets, it flows through pipes that only reach asset holders. For low ground, not connected to those pipes, water appears to be rising. But all that actually accumulates is reduced purchasing power. After the flood recedes, high ground land values soared. Low ground, only mud remained. Same market, same time. One group took the elevator. The other stood still. No, not still. While the elevator rose, the rest descended, relatively. Economists called it a K-shaped recovery. Two trajectories inside one economy, one going up, one going down. The upper arm and lower arm of the same letter K, existing at the same time. The housing market. From March 2020 to the 2022 peak, U.S. home prices rose 34%. Those who had barely saved enough for a down payment before the pandemic, 2 years later couldn't even afford the down payment on the same house. Meanwhile, those who already owned a home, their assets grew 34%. The gap between those who save through labor and those who hold assets doubled, tripled. The first rung of the housing ladder disappeared. One sentence captures what these numbers mean. In 2020 America, the economic pain created by the pandemic was shared by everyone. But the money created to compensate for that pain reached only those who held assets. Pain was distributed. Profit was concentrated. The Nasdaq, March 23, 2020. The bottom, 6,860. December 31, 2020, 12,888. Up 88% from the low in 9 months. Tesla, January 2020 share price, $90. December 2020, $700, up 743%. Founder Elon Musk's net worth grew by $150 billion in that single year. On average, $400 million per day. Is this wrong? Judging that is not our work. We track structure. Why, in the same time, same country, same crisis, such different outcomes? The answer is simple. The pipes were connected to different places. Were they geniuses, those who predicted all this and moved accordingly? Wednesday afternoon, March 18, 2020. Investor Bill Ackman appeared on CNBC. Voice breaking, he said, "Hell is coming." The 18-minute broadcast spread. Fear was distributed. 2 days later, he closed a $2.6 billion short position. Under 2 months of holding. Return, 27 times. That same day, he began buying hotel stocks, companies like Hilton, at scale. He sold fear. He bought the bottom. You could call him a genius. But there were other managers using the same strategy at the same time. The difference was not judgment, it was timing. Days, weeks. That gap separated profit from loss. The decisive variable was not intelligence. Ackman was already on high ground. He was not someone who felt fear. He was someone who distributed it. And even he wasn't perfect. His Hilton position in the second half didn't go as planned. Capitalizing on crises involves luck. But structure creates the opportunity. And that opportunity opens first and more easily to those already on high ground. Europe. The ECB launched its Pandemic Emergency Purchase Program in March 2020. Scale, 1.85 trillion euros. The result mirrored the United States. Eurozone equity markets recovered fast. Property prices rose. In Frankfurt, Paris, Amsterdam, home prices rose more than 20% on average between 2020 and 2022. Lower income purchasing power, unchanged. Japan. The Bank of Japan had already run zero-rate and yield curve control policy for years. The pandemic expanded the scale. The result was the same. The Nikkei rose 74% from its 2020 low, reaching a 30-year high. Redistribution favored asset holders. Different countries, same structure. When central banks supply liquidity, it flows through asset systems. It reaches only those connected to those systems. This is not America's story. This is the story of every capitalist economy. This is not left-wing redistribution theory. It is not right-wing free market ideology. It is a physical observation. When central banks supply liquidity in a crisis, that liquidity follows existing asset structures, the way water flows downhill. Liquidity reaches where assets already are first. This is not intent, it is structure. But between those who understand the structure and those who don't, outcomes differ. Crises do not end. They return in different form. And in every crisis, liquidity flows in the same direction, up. When the next flood comes, one question is enough. Am I standing on high ground or low ground? In other words, which pipe am I connected to? When fear spreads, that pipe decides whether we throw or catch. When liquidity arrives, that pipe determines how fast we can move. One more specific question. Of our current net worth, what percentage consists of assets that rise when central banks cut rates towards zero? Stocks, real estate, long-term bonds, commodities. The higher that percentage, the closer we are to high ground. The lower, the closer we remain to low ground. The number is not an answer. It is a signal, revealing where we stand. This is not investment advice. We are not telling anyone what to buy. We are asking, confirm the terrain you stand on. Without knowing your position, when the flood comes, there are no options. March 2020. A crack opened in the global economy's reservoir. The central bank pumped water. Trillions in liquidity entered the financial system. The water flowed to high ground first. After the flood, the terrain changed. High ground rose higher. The distance to low ground grew wider. When the next crack forms, the flood returns. The water will flow the same direction again. The question is not, will the flood come back? The question is, where will we be standing when it does?